Oil above $100, record highs in the S&P 500, and a historic rally in semiconductor stocks are colliding with the most serious energy shock in years. Welcome to vTalkInsight, Equity Pulse Daily for April 27, 2026. Let us unpack how AI-driven earnings, tightening financial conditions, and geopolitical risk in the Strait of Hormuz are reshaping the equity backdrop. Global equities are trading against a difficult macro background where energy is the key swing factor. Brent has jumped roughly 16% in just 5 days and is now well above $100 after a 45% rise since February linked to the prolonged closure of the Strait of Hormuz. With U.S. and Iranian forces maintaining blockades and no visible path to a comprehensive deal, markets are treating this as more than a short-lived supply scare. This oil surge is feeding renewed inflation anxiety. Developed market headline inflation is now expected to push toward or above 4% in coming months, even if the pass-through to core is judged more limited. Some central banks are inclined to look through what they still see as an energy-driven, largely transitory spike, keeping rates on hold rather than rushing to tighten again. But in the U.S., upstream producer prices have been firm for several months. Core services and tariff-sensitive categories are running around 3 to 4%, and the next personal consumption expenditures report is expected to show inflation moving up toward the mid-3% range. That mix is showing up in rates. Yields on 10-year benchmarks like German bunds and Japanese government bonds are pushing toward multi-decade highs, while U.S. 2-year yields have risen sharply as markets push back the timing of Federal Reserve cuts toward September or later. Some economists now openly entertain the possibility of no U.S. cuts this year if inflation stays sticky and unemployment remains low. Despite that, equity and credit risk premiums have fallen to around 20-year lows. Markets price roughly a 90% chance that growth does not meaningfully weaken, and liquidity is generous, with broad money and loan growth running near a 10% annualized pace. Investment-grade bond issuance is being absorbed with minimal concessions, and even high-yield AI and data center deals are mostly clearing, though a few have lagged. The bigger systemic concern flagged now is not absolute yield levels, but the risk that a spike in bond market volatility, perhaps triggered by geopolitics, forces a more abrupt repricing of equity valuations. Against that macro backdrop, headline equity indices look remarkably strong. The S&P 500 has just delivered a fourth consecutive record weekly close, with support from names like Texas Instruments and Intel, while the Nasdaq and major semiconductor indices have powered to all-time highs. Yet beneath the surface, breadth is thin. On a recent record day, only 177 S&P constituents advanced, and just 5 sectors finished in the green, underscoring how dependent the rally has become on a narrow cohort of large technology and chip stocks. Semiconductors are the epicenter of this leadership. The Philadelphia Semiconductor Index has outperformed the S&P 500 for weeks, logging its best single session since the late 1980s and an 18-day winning streak that has driven gains of more than 40% in under 3 weeks. Flows and positioning evidence suggest that much of this move is being powered by systematic strategies and hedge funds rather than long-only investors, raising the risk of an outsized reversal if momentum stalls or volatility picks up. Geographically, the divergence is equally stark. U.S. and North Asian technology equities continue to rally on AI enthusiasm and strong earnings, while European markets are struggling with the energy shock. European indices are lagging U.S. benchmarks this week, with most sectors under pressure apart from energy, which is benefiting from Brent near $106. European cyclicals have actually bounced despite deteriorating economic surprise indices, and earnings growth there is expected to be modest and concentrated in banks and energy, while other sectors face flat or negative trends. That pattern reinforces the sense that global equity performance is being driven by a few AI and energy winners in an otherwise more fragile environment. The most powerful bottom-up story in equities right now is the AI-driven hardware cycle, and Intel sits at the center of it. Intel just delivered its largest revenue beat in 5 years, driven by strong data center CPU demand, with next quarter revenue guidance as much as 14% above consensus and its share price surging more than 20% toward record highs. Management guidance points to continued strength as AI deployment shifts from training to inference, increasing the role of CPUs in orchestrating agentic AI workflows and lifting the CPU to GPU balance in data centers. Those dynamics extend well beyond Intel. Other CPU manufacturers are flagged as likely beneficiaries of this structural shift in workloads, while AMD is guiding to roughly 35% annual growth through 2030, supported by exposure to both CPUs and GPUs and deep relationships with customers like OpenAI. NVIDIA is singled out for having secured its supply chain and being less exposed to ongoing disruptions, supporting its role as a core free cash flow compounder in large-cap semis. In Asia, Taiwan's decision to let funds allocate up to a quarter of net asset value into a single stock is expected to unlock substantial incremental flows into TSMC, already over 40% of the local index, reinforcing its position as a key liquidity and AI infrastructure hub. Capital spending data underline how broad this AI infrastructure build has become. AI-related capex is estimated to be up about 60% year-on-year, reflecting both higher chip prices and growing conviction in the AI transformation story. Meta and Microsoft are cutting a combined 23,000 jobs and redirecting savings into GPUs and data centers, while hyperscalers are locking in long-dated debt at yields between 5.5% and 7% to secure funding for massive build-outs, even at the cost of higher interest expenses. This is driving a clear rotation within equities from software toward hardware and infrastructure, with investors favoring more tangible AI exposure and stronger free cash flow generation. The same AI demand is spilling into power and energy infrastructure. Siemens Energy has raised its outlook on the back of strong orders from data center and grid customers, and Baker Hughes highlights robust multi-year energy demand linked to infrastructure, liquefied natural gas projects, and AI-led electrification. Middle Eastern energy companies are pressing ahead with long-term projects, including Baker Hughes' new contract with Qatar Energy, signaling confidence that demand will remain strong even beyond the current conflict. But the build-out is running into physical and financial constraints. Supply chain stresses in inputs such as helium and bromine and disruptions from the Strait of Hormuz are expected to push up semiconductor and data center costs later this year. On the funding side, Oracle's $300 billion AI partnership with OpenAI is reportedly straining bank balance sheets as they work to syndicate associated loans, and some high-yield data center deals have underperformed, suggesting that credit markets are starting to differentiate more finely within the AI theme. While AI infrastructure enjoys abundant capital, the real economy is feeling the strain of higher energy and living costs. Rising oil prices are already reflected in UK retail data, where fuel outlays are taking a larger share of spending and crowding out categories such as household appliances. Survey evidence suggests as many as 80% of U.S. consumers plan to cut back, with middle-income households, and particularly women who have driven much of the income growth, seen as especially vulnerable to energy shocks. Real wage gains have reportedly fallen by more than 80% since the Iran conflict began, pointing to a meaningful erosion in purchasing power despite positive nominal wage growth. Cyclical equity sectors tied directly to fuel costs are already showing the impact. Major U.S. airlines are facing significant profit headwinds from jet fuel, with American Airlines alone projecting around $4 billion in additional expenses this year. Companies across the sector are raising ticket prices, exploring asset sales, and contemplating workforce reductions or consolidation to protect margins, while Spirit Airlines is highlighted as facing existential risk and even talk of a possible bailout. In consumer goods, Electrolux has seen its shares drop more than 20% after weak results in North America, and analysts caution that earnings expectations for consumer-linked companies may prove too optimistic if inflation remains elevated. Europe looks particularly exposed to this squeeze. Germany is described as facing a stagflationary mix of rising prices and slowing activity, driven by supply shocks from the Persian Gulf conflict and energy bottlenecks, with normalization of energy and intermediate goods supply unlikely before autumn, even if the conflict ends soon. Berlin's debt-financed spending on defense and infrastructure is providing some support, but leaves limited room for further stimulus without stoking more inflation, and other large European economies such as France and Italy have even less fiscal space. Offsetting forces do exist. Defense companies, especially smaller names, are projected to benefit from several years of roughly 25% annual growth as stockpiles are rebuilt and the energy transition is getting a boost. Fast-charging electric vehicle infrastructure has grown about 25% year-on-year. European EV sales are up by roughly a third, price gaps with internal combustion cars are narrowing, and retailers adding charging stations are seeing longer dwell times and higher in-store spend, all of which point to emerging winners even in a tougher macro setting. Beyond public markets, the private AI landscape is adding both excitement and risk to the broader equity story. Anthropic's Mythos model is attracting intense investor interest, with potential valuations discussed near $800 billion, positioning it as a direct challenger to OpenAI in large language models. At the same time, reports of unauthorized access to Mythos have sharpened concerns about real-world cyber vulnerabilities, underlining that security lapses at key AI providers could quickly become a systemic issue for technology supply chains. Competitive pressure is also building from lower-cost models such as DeepSeek, while SpaceX's proposed $60 billion acquisition of AI coding firm Cursor signals an aggressive push to develop proprietary software capabilities and reduce dependence on third-party models. Regulation is starting to catch up with these shifts. In prediction markets, the U.S. Justice Department has charged a soldier with insider trading on Polymarket, and authorities are widening their scrutiny to include both criminal and civil cases, as well as large futures-style trading linked to oil and equities. Platforms like Polymarket and Koshi are now working more closely with regulators and flagging suspicious activity in an effort to avoid harsher rules as they seek broader approval. This heightened focus on the use of sensitive information adds another layer of compliance risk for some of the more speculative corners of the market. In consumer credit, a different kind of structural change is underway that could matter for housing-related equities. A regulatory shift has ended FICO's long-standing dominance in U.S. mortgage underwriting, with Fannie Mae, Freddie Mac, and the Federal Housing Administration now accepting VantageScore for the majority of new loans. FICO's shares have fallen roughly 40% year-to-date on the back of this change, while VantageScore's use of alternative data such as rental and utility payments is expected to generate around $1 billion of cost savings for lenders and borrowers and potentially unlock more than $1 trillion of additional mortgage volume over time. However, high mortgage rates and rising home prices mean that improved scoring alone will not fully resolve affordability challenges, so any boost to housing activity is likely to be tempered by the broader rate environment. Stepping back, global equities are being driven by two powerful and conflicting forces. On one side, AI-linked earnings, historic semiconductor momentum, and strong corporate and credit market balance sheets support an ongoing risk-on bias and record index levels, particularly in U.S. and North Asian technology. On the other, a severe and prolonged energy shock, persistent inflation pressures, rising bond yields, and the prospect of more volatile rate markets sit uneasily alongside record low-risk premiums and increasingly narrow equity leadership. Key signposts now include the path of oil and Middle East negotiations, upcoming inflation and personal consumption expenditures data that will shape the Federal Reserve narrative, and the next wave of big tech earnings that carry outsized weight in index performance. At the same time, watch for how supply chain bottlenecks, AI infrastructure funding, and regulatory developments in areas like prediction markets and credit scoring intersect with valuations across both growth and more cyclical sectors. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.